I think we've seen investors jump from one side of the boat to the other pretty dramatically because the big fear and worries in the fourth quarter of last year was that the Fed was on autopilot and continue hiking. If we were a little bit more balanced, I would say that interest rate risk wasn't to the same degree, but the 10 years collapsed, substantially. And now I think it's, if anything, the expectation might be a little bit too optimistic.
Too benign.
Too optimistic, and then there may be a little bit of too much risk, significant inflows into fixed income. There's an insatiable demand for bonds. And so to say that interest rate risk is off the table, I think might be a little bit of a concern moving forward.
Internationally, Ron, we've seen outperformance or very strong performance in China in particular and other places in the world. The China data seems to have turned more recently with the PMIs, most recently PPI and CPI coming in line. Are you more optimistic, or do you feel like that's an area of the so-called boat where people are sort of crowding onto the other side at this point?
Well, I don't know if they're crowded. I mean, it really just, emerging markets in China just started to outperform since about last November. And so you've had a pretty good run there, but also China's down 50%, peak to trough from 2015. So there could be some additional room there, assuming they continue to try to stimulate their economy. Now, having said that, I mean, you probably want to look more at individual stocks than you want to play indexes anywhere in the world. But global growth is slowing. And that, the Fed has made that point rather explicitly, that the rest of the world is slower than the U.S. and could act as a drag on growth going forward. Certainly you see that in Europe, where the preponderance of negative interest rates reside. And as Tyler mentioned earlier, that is a concern, that spreads beyond the continent, even though we got some good news on Brexit lately.
It would all depend on inflation, Michael, right? I mean, even this morning, producer price index, maybe a little high for the month, but the core trend is still down. PCE, time and again, you look at these gauges, that would be the biggest upset to the current state of the whole global financial markets, wouldn't it?
Right. But what I think is always interesting is you try to peg where inflation's coming in. One of the big variables is going to be energy, right? And so as we're seeing right now, if you look at a year-over-year comp, where your starting point for oil was a year ago versus today, you're considerably lower. And you see that starting to tick up in the headline numbers. Core PCI, PCE, CPI really isn't showing that yet. But let's go out 6-7 months when our base effect is that oil, having collapsed in the fourth quarter to in the $40 range, and even if we're at a $60, $65 barrel range, that's going to be a substantial increase on a year-over-year basis. So,
but if I could, just the inflation that is occurring, to the extent that it's occurring, is showing up in areas where the Fed has no control. Energy prices, education, and healthcare. Fed cannot do a single thing about that with rate increases.
The problem as we go into earnings season, though, is that these are the costs that corporations face, right?
So margin
along
compression,
with some rising wages. And so, what are we going to hear on those conference calls when they start talking about the effects of rising oil prices, rising healthcare costs, and also a stronger dollar, by the way?
Well, and look, this has been the concern since late last year, right, is that you're not going to get favorable comps when it comes to earnings on a year-over-year basis, because 13 points of the 26 percentage point increase that we got in profits last year was from the tax cut. So now it has to be organic growth, and then has to pick up in order to presumably get multiple expansion, even though we've seen some of that so far this year.